rate since 2008.
So
So
you repeat that again to me on the earnings
so
side?
the earnings for the S&P 500, the stocks that have reported, okay, is the following. 31, here it is, 31 companies in the S&P have reported. 1 out of 3 are missing their earnings of those 31. So 10 out of 31 have missed. And it says, we haven't seen that since the financial crisis back in 2008. So that, maybe it'll pick up or change, but early on, these companies are missing at the rate that they were missing right before, which is pretty incredible.
Well, can I ask you an honest question?
Yes.
When you were first in the school enrollment and going back, let's say 4 months at least, there was a forecast that I had talked about what January earnings were going to look like. Do you feel that the forecast that I gave about growth needs to contract? As it does contract, then the broader part of the S&P will have to mark itself down and get the slowdown built in so that there may be able to be bull rallies? Are you seeing that the forecast was correct?
Oh, yeah. There's no question that you were talking about, this months and months and months and months ago. And, that's why I sent you the article, because it's statistical facts to back up what you were saying. You may not need them, but it's kind of...
Yes, I do. I would like to have them because the value of the school here and the apprenticeship value of the school is that you have been around a very long time. You're a very smart, educated man. And you have seen many, many things and many, many stories and many, many analyses throughout your investing career. And what I would ask you is that part of the fundamental analysis that SMF teaches you, you can see now what the earnings season is going to start like on Tuesday of this forward-looking week. Today's 1/14/2012. So what do you think what do you think the scorecard will be? Because they're not, so we know they're marking it down, right?
Yeah. And that's the other thing the article said, is that it validated the comment about that the earnings. We know that the fourth quarter numbers were drastically reduced over the last 3 months, but the early indicator reporters, 31 companies out in the S&P have had 1 out of 3 that are missing estimates. We haven't seen this since the financial crisis in 2008. So
right.
I think even the question even further is, well, they've marked it down and they're still missing.
Right.
So
right.
So they marked it down and still missing, which means, and I think what the trouble is the forward-looking estimates that you're not getting a lot of visibility out of are probably worse than they think. And I think that's what's driving you to think that is probably going to affect how Ben's thinking, because when you're missing earnings, guess what happens? The companies start contracting their employment base, and
That's exactly right.
And they start contracting the economy.
That's right.
The only way to get ahead of that curve is to do an injection, or silently do the injection. Call it a 3% bank loan or a 1% bank loan on $500 billion, right? And
right.
you can call it, we will buy mortgage-backed securities at the rate of $750 billion or some stupid stuff like that. It's just the same thing.
They're going to do that. That's called QE3. You're right. So they're going to do it silently, and the public will not be aware of it.
Well, what I'd say to you is that there's no question that you called this, and we're calling it. You called the top. You called the top back there in August, and whenever it was, June, July.
Well,
August.
I did one in April of 2012, toward the end of April, I said there was a correction around the corner coming.
So you're about. I mean, there's no question we have a chance to be ahead of the curve if we listen here. The other one that you call rightly so is the retailers. If you go look at the retail REITs, the retail ETFs, man, they all tanked. And you were telling us, short them, short them, short them. Now you didn't come out and say that, but these things are ready for shorting. Well, they all went down. So I think we're getting a good enough
markdown.
Well, no, it's visibility, right?
Right. That's what I mean.
That's what you're giving us early visibility on what potentially is going to happen. And, our responsibility is to get positioned to take advantage of it, right? And, put things in motion that allow us to take advantage of it. So.
Right, and this is very true. Then the thing that we have keyed in on specifically then is we know that the retailers are going to go down, because retailers normally don't mark themselves down like this going into January. You do know that, right?
No, because I haven't been around long enough. I don't know.
Well,
because you've got decades of the retailers have done this and done
this,
in January, and I just don't know.
Well, that's okay.
I believe you, but I just don't have the experience to know that generally in January the news is a little bit better.
Well, think about it. If you were really doing well in the Christmas holiday season with gross margin profits, you wouldn't be guiding down the way they are right now, because nobody thought about shorting those retails. You hear me?
Yeah.
No one did.
I wish I had listened to you.
Well, no. The wonderful thing about the apprenticeship and the training is that you get validation of accuracy and forecasting before the fact, and you get the warning signs that are going to be the contributing factor. And one of the things that I would say about the current market, and we're going to really get into our training about it, is the value of knowing the markdown going forward and the volatility. We've had triple-digit volatility, and I said we would have that on Monday when we had that gap up in triple-digit. That's when I said the higher volatility is going to come back into the marketplace. And throughout the day and this morning, we're going to go hunting for the best opportunities that are going to be ahead. One of our strategies for the calendar earnings season is that if anyone is ever watching the video or listening to us, is that definitely get some training and some skills, because the volatility and the manipulation and the way that markets have certain structures of creating certain events around certain equities and options and everything involved, it can be very manipulative and volatile. And that is a big asset that you're trained about here at SMF. Would you not say that that is correct? Or would you say that that's correct?
Yeah, I think that's a fair appraisal.
It is. And so another thing we're going to be talking about today is some of the standard technical analysis that's applied. And the earnings season, our strategy here for the bull side strategy in the earnings season forecast right now, today's dates, 1/14/2012, we already heard earlier in the video how they've been getting marked down. It's the training that we were giving about stock fundamentals and economic analysis. And so you got all of Europe, you got all of Asia, and you have the U.S., and then you have some of the Middle East. So what? You got, here's the ones that count though, is when the Chinese get back on board, when we get in the earnings season, we'll be looking at all of the commodity related stocks that are going to get marked down to levels that will be able to be bought. Because what will end up happening is it will price in the 2-year China slowdown is at a 2-year low. So we do know that we're going to hit a bottom over there in that part of the world. We know that Ben Bernanke is going to put QE3 into play just like they did QE2. And that would come more toward March instead of the middle of the year. We had two forecasts. We do everything on a quarterly basis. So that forecast is going to come into play sooner than the June one. What the market will experience and why investors should always remain on the sideline that have no experience is let the companies, let the volatility get marked down, find out where the best deals are, find out what gets relevant to its earnings at a lower growth rate. So, yes, the thing about what I heard in this video from MMT is that they start contracting the workforce. And when you go back to the 2008 period, I shorted that whole year before the year started. Yes, I did. And the thing about it is that it was because the earnings contraction that would come. Now, we've gone through that process, and we're going to get another round of that QE3 stimuluses that's going to help the European banking system because we know that it will. And it's a form of pure steroid injections that will wind the tapes higher once the earnings come down to meet the lower growth, let's say 1 to 3% on the year and forward looking. And if the retail crowd wants to set their earnings in that capacity level, and the CEOs want to come out during the conference calls that are going to start coming out next week, Google's up. We got lots of big ones. Apple's going to be coming our way, but they're all going to have one theme, and the theme is they're going to bring their estimates down. And if their inventories are lean, then, and they've been managed correctly, well, then everything's going to really fall into play for a potential bull side. But you have to remember that the bull side of the market is a stimulus that's being injected because of the worldwide turmoil in the financial system is at systemic risk levels. They will work similar to the TARP that we had here in the USA when we came from the 2009 breakout, March breakout of '09. We were there, and we come all the way up. But now we have a contraction. They can blame it on Japan. They can blame it on Thailand. They can blame it on whatever they want. However, when you're working with stock fundamentals, they price it in so that they can meet the next report. And that's the kind of things that we're going to be hunting for in the earnings season. And there are going to be some great opportunity and some put options because, yes, they're going to get marked down and then they're going to bounce. So that's the bull side of setting up a bull market. Now, the bear in the short term is going to feed on it and try to drive the prices down. But then it's people like us that get to buy the good quality leadership at the bottom. And relative to its forward-looking growth rate and forward-looking stimuluses that would be injected worldwide in the system, in the financial banking system, is where that would support the investor, the pension fund managers, the mutual fund managers, the Wall Street gurus again. It would all, once again, wind itself right back up. And it could happen, and probably will happen, before March. Because of the systemic risk and downgrades over the current weekend that we're in on 1/14 of 2012, is you've had 9 major European countries downgraded in the financial system. All of what needs to happen, however, it's going to take a boatload of money, and that's where your financial injections come into the system. And it's very important to understand the mechanics of Wall Street the manipulation of Wall Street, the manipulation in the exchange model in the bid and the ask, and relative how they mark calls down like this right here. Here's an example of what I'm talking about. Calls are 554, they mark them down to a penny. On options expiration weekly right here. Google's a great stock, but look what they did in the option bid to people. That's what happens. That's what I'm talking about. Now, relative to our plan, we're going to go into our planning stages next. And we're going to go directly in there, and we're going to start hunting for the value, and we're going to look at where that first bull pullback of calendar 2012 is going to find its support levels, and where the lower end of those markets, most importantly, is how do I get the good buys off the bottom. That workshop we're going to be going into. We're going to be talking a lot about the markup and the light on balance volume. We're going to be talking about a Keltner band. We're going to be talking about the market maker platform versus standard indicators. We're going to be taking a look at the S&P 500, NASDAQ 100. We're going to be taking a look at where the sector rotation will be on sale and where the ones that are overvalued, just like in the retail. Retail had to get marked down because it had to bring its numbers in line. Why did you mark it down? If you're doing good, you're not going to mark them down. You don't mark them down, you mark them up. So they mark them down. The gimmicks that are used in earnings and after hours and accounting processes and headline numbers and headline events creates extreme volatility. And, you know, it's very hard for people to keep up with that. However, we're here. We'll help you. We're going into our workshops. One of the features that I'm going to be looking at right here is that $1,200 put and how they mark this thing from $150 some down to $18. Yes, it's a 1,200 put for March, and we'll be talking about those today as well.